Hello friends, I welcome you all in this session, and in this session we are going to talk about financing of projects. Once you have identified a project, now you need to look for funds for that particular project. So, how to arrange funds? What are different sources? So, we should look at all those things, right? So, there are two types of decisions. You have got financial decisions and investment decisions. Financial decisions are relatively easy to make compared to investment decisions, because of there is more perfection in the market when you talk about financial decisions, while in case of investment decisions you have got more imperfections. Financial decisions most of the times they take place in capital markets, while investment decisions they take place in real market. In case of financial decisions, we generally observe the value of similar financial assets, while in case of investment decisions what we do, we estimate the value of capital projects, right. So, that is another difference between financing decisions and investment decisions. And the another difference between these two is that financial decisions we think that there are very few there are very few opportunities to get NPV which is significantly different from 0, while in case you have got several opportunities, right. So, there are many opportunities in the area of capital budgeting that have an NPV significantly different from 0, while there are very few in case of financing decisions, right. Now, you have got two types of sources as far as financing is concerned. You can broadly classify them as shareholders funds and loan funds, or equity funds and debt funds, right. So, can you tell me what are the differences between these two? There are two sources of financing. You have got equity funds and debt funds, right. Let us look at couple of differences, right. So, as far as the duration is concerned, equity ordinary has indefinite life, while the debt has fixed maturity. If you look at the first difference, the equity shareholder will have residual claim over income of the firm, while the creditor who is supplying you debt have a fixed claim in the form of interest and principal. So, you need to pay only interest and principal to creditors, while the equity shareholder will have claim over income of the firm in the form of dividend, right. So, equity shareholder or equity investor enjoys prerogative of control over the firm in terms of voting right, right. While creditors they have got very passive role, they do not have voting rights, but in some situations they may have voting rights. Dividend paid to equity shareholder is not a tax deductible payment, and this is one of the most important differences between these two. The dividend paid to equity shareholder is not a tax deductible payment, while interest paid to creditors is a tax deductible payment. So, these are couple of differences. So, after finding or after knowing the differences between equity fund and debt fund, let us look at how should we determine the combination of these two in a particular project. So, should we use more debt or should we use less debt or more equity or less equity, right. So, there are certain factors which would decide these two things, right. So, first is cost. As far as cost is concerned, debt is quite a cheaper source of fund, but it is quite a risky also. On the other hand, equity is less risky, but an expensive source, right. So, this is a so you need to have a balance between these two, right. One is cheaper but riskier, right. On the other hand, the other one is less risky but expensive, right. If you look at nature of assets, so nature of assets in the project would decide whether you should use more of debt or less of debt, right. So, it is said that if the project has got more of tangible or it is a tangible in nature, then you should go for more of debt. If it is more of intangible, then you should go for more of equity. So, intangible products can be, or intangible things can be, let us say brand image of a firm, or let us say software, right. So, you should use more of equity in those cases. Business risk is also one of the criterion which would be considered to look into decisions of debt to equity ratio. So, if risk is more, it is good to go for equity, right, otherwise go for debt, right. So, debt equity ratio can be 1:1, can be 2:1 for capital incentive projects like power project. Sometimes it can be this also, right, and it can be even more than this. So, debt can be more than even this value. If you look at control consideration criterion to decide about debt to equity ratio, then it depends on how much is the control of promoters, and that would decide debt equity ratio. So, let us say if there is a project, cost of project is let us say 10,000 and promoters can invest 2,000, right, and the promoters have decided that they want minimum 50% stake in equity of the project, right. So, the total equity cannot exceed 4,000, hence balance is 6,000, right. So, debt equity ratio would be what? It's 1.5 to 1, right, it is 6,000 and 4,000, right. So, if they want a minimum stake of 40% in equity of the project, then this ratio would be 1/1, right. And market conditions also play important role in deciding debt to equity ratio. If market conditions are, let us say favorable, then it is good to go for more of equity, otherwise go for more of debt. So, these are couple of key factors which you should use while deciding debt to equity ratio. So, this is checklist when you should go for more of equity. You should go for more of equity when corporate tax rate applicable is negligible, otherwise if it is not negligible, or if corporate tax rate is very high, go for debt, right. As I said, business risk is high, go for more of capital. If dilution of control is not an important issue, then go for equity, otherwise go for debt. The assets of the project, if intangible, go for equity, otherwise debt. The project has many valuable growth options, it is good to go for equity, otherwise go for debt if the project has got very few growth options, right. So, this is a checklist of determining debt to equity ratio. Now, there are several sources of finance. So, we can put them into two categories, two parts. So, part A and part B, right. So, first we will see part B. So, sources of finance, you can have equity, as I said, equity and debt are two sources. In equity you can have different types of equity. You can have equity, you can have preference, you can have internal accruals. We will see what these things are. In debts we have got bonds, term loans, working capital, advances and miscellaneous sources. And in part A you have got internal accruals, securities, term loans, working capital advances and miscellaneous sources, right. So, as I said, you have got two sources, equity and debt. So, from where you would be arranging these two funds? Either you can go for public source or you can go for private source, right. So, when you go for capital raised, if you are raising capital from public source, is in the form of security offered to public through an offer document filed with SEBI, right. If you are going for private capital, then it may come from, let us say, bank or insurance company, or you can have, let us say, venture capitalist, isn't it. So, there are several other options available when you are going for private capital source, right. So, let us look at different pattern of financing. So, first of all, what happens when you form a company? First of all, you would be issuing equity shares to promoters, right, and they are nothing but they are founders. In most cases to a select group of investors, right. So, you would be issuing equity shares. When you need some more money, you need to look for some other avenues of sources, right. So, you can go for IPO, right, initial public offer, or seasoned offer, right issues, private placement and preferential allotment, right. So, for more funding you need to look at all these options, right. So, let us look at what is internal accruals. So, internal accruals are of two types. First is depreciation, amortization, and the second one is retained earnings. Retained earnings are nothing but the revenue, the revenue foregone by shareholders. It is basically the dividend part which shareholders have foregone, right, or they have retained with the company. And this retained earning can be 30 to 80%, right. So, let us take an example of depreciation amortization. So, if there is a machine having cost of, let us say, 10,000 and its life is 5 years, so depreciation per year is 2,000, right. But actually it is not, it is a non-cash charge, right. So, this also forms part of internal accruals, right. So, there are some pros and cons of this particular source, right, internal accruals. So, the pros is it is readily available, right, and the management need not talk to shareholders, right. And the one of the cons is it's limited amount, right. Then opportunity cost of retained earning is high, as it is equal to the cost of equity. Remember, as I said, the retained earning in a sense is dividend foregone by equity shareholders, right. So, this is internal accruals. Now, what is equity capital? Equity capital represents ownership capital, as equity shareholders collectively own the company. So, all those equity shareholders, they are nothing but owners of the company, right. And that ownership is up to what? Up to what level? Up to the level of that particular value of the share, right. So, they enjoy reward. If more is the, if profit is more, they would get more dividend, right, and of course, they will have to bear risk also, right. So, equity capital can have different forms. The first is authorized capital. the company when the company the amount of capital a company can potentially issue as per memorandum is called authorized capital, right, and the company the amount offered by the company to investors is called issue capital, right. So, authorized capital according to memorandum, whatever the company is issuing is called issue capital, right, and the amount subscribed by shareholders is called subscribed capital, and the actual amount paid up by the investors is called paid up capital, right. So, equity capital can be classified as authorized, issued, subscribed and paid up capital. Now, let us look at what are the rights of equity shareholders. They have got lots of rights. They have got right over income, right to control, right, by the way of voting, right. So, they would be selecting board of directors through voting, right. Preemptive rights means preemptive rights are those rights in which they would be getting, whenever company issues some more shares, they would be getting some shares. So, they would be getting some preferences. So, let us look at this example. Let us say 100, let us say 1000 outstanding shares, right. So, company is going to let us say these many shares are on offer, right. So, proposes to issue 200 let it be like this, it is 20,000 equity shareholders, right, and a shareholder has got 100 shares. So, he will have right over how many shares? He would be having a right to 20 shares, right, because he is already having 100 shares, right. So, so what is preemptive right? Shareholders maintain their proportional ownership by purchasing the additional equity shares issued by the firm. So, these are outstanding shares. Out of these many outstanding shares, the company proposes to issue 20,000 shares, and if I am already having 100 shares, I would have right to have how many more? 20, right. Right in liquidation, of course, as in case of income, equity shareholders have a residual claim over assets of the firm, but after settling claims of debenture holders, secured and unsecured lenders, other creditors and preferred shareholders, right. So, once you make payments to all these four, then whatever is remaining, on that remaining portion shareholders will have their rights, right. So, that is right in case of liquidation of the firm. There are certain advantages of equity capital. It is a long term source. In case of insufficient cash, no need to pay dividend to shareholders. This is a very a plus point, right. Equity capital has no maturity date, and hence the firm has no obligation to redeem, right. And there are some disadvantages also. You can see this one. The cost of equity capital is high, usually the highest compared to other sources, right. The cost of issuing equity share is generally higher than the cost of issuing other types of securities, right. So, these are couple of advantages and disadvantages of equity capital. Now, you got preference capital. Preference capital takes the benefit of equity capital as well as debt, right. So, it is a hybrid form of financing. So, it is similar to equity because preference dividend is not an obligatory payment. It is similar to equity because preference dividend is not a tax deductible payment. it resembles debenture, as I said it is hybrid form. So, it resembles debenture in these ways, right. So, the dividend rate of preference capital is fixed, the claim of preference shareholders is prior to the claim of equity shareholders, right. This is what we have seen in case of debenture, right. And preference shareholders do not normally enjoy the right to vote, right. So, that is why this is combination of these two, right. So, there are certain pros and cons. The pros are no legal obligation to pay dividends, enhances credit worthiness, no dilution of control, but again the problem is it is very costly source, right. Let us look at debentures. So, do you know what is debenture? Yeah. Debenture actually is akin to promissory notes, and debentures are instruments for raising debt finance, right. That is why they are called debentures. Debenture holders are actually creditors of the company, and the obligation of the company towards them is that similar to other borrowers. So, you need to pay them interest and principal at specified times. However, debentures provide more flexibility in terms of, let us say, interest rate, in terms of, let us say, security or repayment compared to other sources, right. So, this is debenture. There are a couple of things you should keep in mind related to debenture. So, there is a trustee which is appointed through deed, either bank or financial institution or insurer. So, the borrowing firm will fulfill contractual obligations, right. As far as security is concerned, there a company can mortgage its asset as a security, right. And maturity period is concerned, then you can have long term, medium term and short term depending upon these many number of years, right. So, if it is less than 1 year, then they are called commercial papers, right. So, these are the things you should keep in mind while studying debentures, right. Redemption, right. So, debentures are typically redeemable in nature, right. So, redemption is possible. So, you can have fixed and floating rate for debentures, and you can have different options also. So, there are, and the options are embedded. So, you can have, let us say, call option, right, and you can have put option, right. So, when you say call option, it means redemption at certain price before maturity period, right. So, you can redeem debenture, right. Advantages and disadvantages of debt financing. If you look at advantages, the most important advantage is interest on debt is tax deductible expenses, whereas equity and preference dividends are paid out of profit after tax, right. No dilution of control because of no voting power, right. Lower cost of issue. These are couple of advantages. If you look at disadvantages, then you have got fixed interest and principal repayment obligation. Failure to do this may lead to bankruptcy, right. So, you need to pay them interest and principal, otherwise there would be problems, right. So, this is the important disadvantage, right, and there are other disadvantages also, right. So, there are a couple of differences between debentures and shares. Shares cannot be converted into debentures, while debentures can be converted into shares, right. So, this is the important difference. and a person having debenture would be called debenture holder, otherwise if he has got shares he would be called shareholder, right. And debenture holder is a creditor of the company and cannot take part in management, while shareholder is owner, right, and he has got voting rights and he may actively participate in affairs of the firm, right. Debenture holders will get interest on debentures and will be paid in all circumstances before shareholders, as we have seen in previous slides as well, right. Whether there is profit or loss will not affect the payment of interest on debentures. So, you will have to pay to debenture holder, right. Shareholders will get a portion of the profit called dividend, which is dependent on the profit of the company. It can be declared by the directors of the company out of profit. And finally, which we have seen already, shares cannot be converted into debentures, whereas debentures can be converted into shares, right. Debentures will get priority in getting money back compared to shareholder, right. Convertible debentures, which can be converted into shares at the option of debenture holder, can be issued, whereas shares convertible into debentures cannot be issued. Of course, share cannot be converted into debenture, right. And we have already seen that a company can mortgage its assets against debentures, right. Now, let us look at couple of methods of offering of these shares, right. So, first one is initial public offering, or they are also called IPO. When you go for IPO, you will have certain benefits and you will have certain costs. So, the benefit is that you have access to large pool of capital, and it means if you are going for an IPO, it means you are quite a respectable company, right, and the lower cost of capital in this case, and there are certain costs involved in this method of offering, right. So, this is not IPO is nothing but the sale of security to members of the public, right. So, when the company generates money from public for the first time, it is called IPO, right. Once you go for IPO, when you need some more money, then you need to again visit to market, right. So, that is called seasonal equity offering, right. So, you need to revisit to capital market. Now, there is something called bond offering. Now, the purpose of bond offering is to have a stable cash flow, right, while the purpose of equity offering is to have growth prospects in mind, right. So, there are different ways in which a company may raise finances in primary market. So, either through right issue, and there are several others. So, right issue, selling securities in primary market by issuing rights to existing shareholders, right. This is what we have seen as in earlier slides as preemptive rights, right. So, when a company issues additional equity capital, it has to be offered in the first instance to the existing shareholders on pro rata basis, right. This is what we have already seen. Shareholders may forfeit this right partially or fully to enable company to issue additional capital to public, right. So, the other methods of offering are private placement. Private placement can be in the form of, so it can be to select group of persons, right. It can be preferential allotment or qualified institutional placement, right. When you compare these methods, you can have this particular table. You just look at this particular table carefully and then select which is the best, right. And there are other sources like term loans. So, the currency, security, interest payment and principal payment, restrictive covenants, and as far as working capital advances are concerned, you can have different types of sources to arrange working capitals, right. And there are some miscellaneous sources also. So, with this we end this particular session. In next session we will start with project risk management. Thank you very much.